Now that we've finished all the core concepts, it's time to move on to the next section, which is the market maker models, and we'll start off with time frame alignment. Time frame alignment for market maker models, and what do they look like? One of the keys to finding clean market maker models is understanding the time frames they form on in relation to the time frame of the PD array. So time frames are directly linked to each other, and if you stick to the rules I give you today, you'll have a lot more success in identifying them. So as always, time frame alignment for market maker models. We're going from a monthly PD array into a daily market maker model. We go from a weekly PD array into a 4-hour market maker model, a daily PD array into a 1-hour market maker model, a 4-hour PD array into a 15-minute market maker model, then we have a 1-hour PD array into the 5-minute, and then eventually 15-minute PD array into a 1-minute market maker model. Now, from monthly all the way down to the 15-minute, you can already see these are different types of personalities, right? We have the swing traders over here with the higher time frame, and then the hyper scalpers on the M15 and the 1-minute market maker models. So price is fractal, it just depends on how long are you willing to hold the trade. We've got this nice schematic over here, right? Higher time frame, we got that monthly level. We've got a weekly level or a daily level. Pick one, right? Which is most preferred for you. Scalpers most of the time want to have a daily level, right? 1-hour structure and PD arrays on the market maker model. Go to the 5-minute buy or sell program and market maker model entries. So same for a higher time frame on the monthly, right? We look at the daily structure, PD arrays for the market maker model, and then on the 1-hour, a buy or a sell program with market maker model entries. Time frame alignment for market maker models. So in a market maker buy model, there is almost always at least 2 stages of accumulation on the sell side of the curve, and in a market maker sell model, there's almost always at least 2 stages of accumulation on the buy side of the curve. The curve is defined by the lowest low in a market maker buy model and the highest high in a market maker sell model. So we've got this schematic for a market maker buy model over here. A market maker model always starts off with a original consolidation. So this is easily depicted by obviously a consolidation, then price expanding lower into another accumulation phase, right? So accumulation phase number 1. Think about market cycles too, right? Consolidation, expansion, consolidation, expansion, another accumulation phase, and then we hit that discount array, and there is the moment where we can anticipate a smart money reversal. Not earlier, we need to hit a key level. If you want to see a market maker buy model, we need to hit a discount array. So we've got this sell side of the curve over here, having our highest high up here and our lowest low down here, and then once we break structure upwards, after hitting that key level, right, we can go into buy side of the curve. Now same for a market maker sell model. Think about the original consolidation which needs to be present in a market maker model. We've got this consolidation down here, expansion again, right? Accumulation phase number 1, another expansion, accumulation phase number 2, another expansion, and then we need to hit a key level inside this premium array, right? And then we have this highest high, confirming sell side of the curve after we break structure and hitting that key level, and then we can start to look for sell opportunities and then completing this market maker sell model, liquidating this original consolidation. All right, so we've got a Australian US dollar monthly chart, and again, keep thinking about the core concepts, right? External to internal range with order pairing. So we've hit that external range liquidity. So what is the drawn liquidity afterwards? We want to go to an internal range, right? So external to internal. What does that look like on a daily time frame, right? Think about the time frame alignments. Can't stress this enough. If we look at the monthly chart, we look at the daily structure. If we look at the weekly chart, we look at the 4-hour structure, etc., etc., right? So On a daily time frame, we can see this original consolidation starting down here. Sell stops below it, obviously, right? Market expands higher, forming accumulation phase number 1, expanding higher again, accumulation phase number 2, and then eventually we keep going until we hit that premium level, right? So over here, that monthly external range liquidity, right? Now we've taken external range liquidity, and what happened up above this old high? Order pairing, right? For smart money shorts. So smart money pushes price down. We've got this break of structure down here, right? Then respecting this fair value gap, and accumulation phase number 1 over here on the sell side of the curve is happening. So we can anticipate lower prices and continuation into sell side of the curve, completing this market maker sell model until we reach that drawn liquidity, which is the monthly internal range liquidity fair value gap. Now on a weekly chart, New Zealand dollar versus the US dollar, again, we've got this time internal range into external range, right? So once we hit that internal range, we want to go and seek external range liquidity. That happens over here from this range high premium levels, right? So this fair value gap internal range makes sense to be a good point where we can reverse from, and then external range liquidity on the low side of this range. Now from a weekly, remember we go to a 4-hour structure. So earlier we had a monthly chart into a daily structure. Now we're going into from a weekly key level into a 4-hour structure. So we're starting off again, original consolidation, right? Sell stops resting below there, external range liquidity, accumulation phase number 1, accumulation phase number 2, expanding up higher into that internal range on a weekly time frame, right? And then over here we break structure lower. Does it make sense that we break lower from here? Yes. Why? Because we hit that internal range liquidity fair value gap on a weekly time frame, right? So now we're going into sell side of the curve, and you can see every premium array is being respected, right? We've got these fair value gaps being respected, pushing down lower, and you can see, think about high resistance and low resistance liquidity runs, right? What do we have down here? Failure swings, failure swing, right? So sell stops are resting below here. Price action wants to keep continuing down, and also think about high resistance liquidity runs, right? We see a rate on this high, for example, or a rate on this high, or a rate on this high, and you see immediate rejection lower, confirming sell side of the curve until we hit that external range liquidity, completing that market maker buy model. So we got E-mini Nasdaq 100 futures chart over here. Again, we think about external to internal, right? So we have daily low sell stops being rated, turtle soup, right? Now we want to go into an imbalance or a lower time frame market maker buy model. So this is a daily time frame, right? Think about we went from monthly to daily structure, weekly to 4-hour structure, and now we're going from a daily PD array into a 1-hour structure. As always, we start off with an original consolidation, right? Always outline your original consolidation and where your market maker buy model draw on liquidity should be, right? From here, we go from external range liquidity, right? Sell stops have been liquidated. Accumulation phase number 1 has happened over here. Accumulation phase number 2 happened over here. And then we form that smart money reversal down here below an old low, right? Sell stops have been liquidated. Again, what happens down here? Order pairing, right? Smart money longs are being accumulated down here, then push price up higher, and buy side of the curve is being confirmed after break of structure, and we're disrespecting a bearish fair value gap, right? Should not happen if we are bearish, so continuing up, respecting bullish fair value gaps, and buy side of the curve has been confirmed until we liquidate this original consolidation up here. Diving one time frame lower, again 4-hour chart, so 4-hour PD arrays, and then we're gonna dive in a 15-minute chart, right? And we keep going down and down inside the time frames, and it is all fractal, right? It works on a monthly to a daily structure, it works from a 4-hour to a 15-minute, and so on. So from this range low, right, to this range high, this is our dealing range. Everything below this 50% level is discount. Now again, we think about external to internal, internal to external, order pairing, very important, right? So we have an external rate over here, or a turtle soup, right? Now, what are we going to be looking for our next draw on liquidity after we take out external? We're going to look for an imbalance in discount, preferably, as our draw on liquidity, which is this fair value gap, right? This fair value gap is also a draw on liquidity, but it's still in premium, right? Because this above this 50% level, this is still premium, so we can dive a little bit deeper down inside this discount level. And how does that look like on the 15-minute, right? Market maker buy models, market maker sell models. It is all fractal. So 4-hour PDRA above an old high external range liquidity. Original consolidation down here, leaving some low resistance liquidity, right? So we know sell stops are resting below here, and that drawn liquidity was way lower, right? The daily or that 4-hour fair value gap in discount. We had accumulation phase 1 happening over here, accumulation phase 2, and then eventually smart money reversal above buy stops, right? Order pairing again, continuing down lower, 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 completing this market maker sell model on a 15-minute time frame. We're diving one more time frame lower, right? 1-hour chart. So we're getting into scalper territory right now. So 1-hour time frame, we can use a 5-minute market maker model. I think most people prefer a 5-minute market maker buy model, so you can have an intraday trade, right? If you're trading off a weekly key level, for instance, you're gonna hold your trades for a few days probably. So 1 hour is for most people, I think, the way to go, depending on your personality, of course. Now, again, we think about external to internal, right? We see these buy stops getting rated over here, over here. So we have external rate. We want to go to internal range liquidity, which is this 1-hour fair value gap, right? And once we hit that internal range fair value gap, we can look for external again. And then we dive into a lower time frame, which is the 5-minute time frame, right? And see if we can spot a market maker buy model forming. Also think about low resistance liquidity, right? Failure swing up here, engineered liquidity. So let's dive into 5-minute time frame. So we got this pretty clear consolidation, right? And inside this consolidation, we can also see a failure swing, right? This high and this high, failure swing, this high to this high, failure swing. And then accumulation phase 1 happens, accumulation phase 2, and then eventually we hit that key level, right? We always want to trade off a key level. So 1-hour fair value gap down here, smart money reversal, and you can actually see this long wick down here rates all this sell stops down here. Again, order pairing, right? External range liquidity. Now we're breaking up structure higher, and we keep respecting this fair value gap, and eventually it pushes up in one accumulation phase, right? So we have that expansion, accumulation phase 1, and then another expansion, completing this 5-minute market maker buy model. Now we dive into the lowest possible time frame for this market maker model. I guess if you want to be really freaky, you can go to a 5-minute time frame and go on a 15-second chart, but I would highly not recommend doing that. And this would be your lowest time frame for a market maker model setup. So 15-minute time frame, again, buy stops have been rated, right? So external range liquidity, and then we're gonna look into a 1-minute time frame. And personally, I think if you do like a 15-minute time frame as your key level and then 1-minute market maker buy or sell model, a pair like GBP JPY is perfect because these pairs move a lot compared to, for instance, Euro USD. Right, so this 15-minute high, right? Remember, buy stops have been rated with this clear this clear original consolidation. Now, after that original consolidation down here, we've got accumulation phase 1 and accumulation phase 2 until we clear those buy stops, right? So key level has been hit, smart money reversal is in, and then we break down here, respecting this bearish fair value gap, and then continuing lower. Again, think about high resistance liquidity runs, right? We see this high getting rated over here, and then you see that immediate drop lower, indicating you're still on the sell side of the curve. And then this should be the draw on liquidity and completing this short-term market maker sell model on the 1 minute time frame.